Welcome back, everybody, to the Deep Dive. This time, we're going way back to 1978
Oh, wow.
to explore Warren Buffett's letter to Berkshire Hathaway shareholders.
Yeah.
We've got the letter right here, of course,
Mm-hmm.
and some really interesting questions from experts to kind of guide our discussion today.
Awesome.
But here's the really interesting thing.
Yeah.
1978 was a fantastic year for Berkshire,
Okay.
but Buffett actually warns
Oh.
that those returns won't last. So how can a great year come with like a warning label?
Yeah.
Let's find out.
All right, let's get into it.
So right off the bat,
Yeah.
Buffett kind of dives into how complex Berkshire's financials are after the diversified retailing merger.
Right.
And he's like really upfront about how those numbers
Yeah.
might not give the clearest picture.
Yeah, it makes it harder to see what's really going on. I mean, trying to understand a company just by looking at its overall financials after a big merger like that is like trying to understand a symphony by listening to one instrument.
Exactly. It's like you're missing all these other instruments that are playing.
You're not getting the full picture.
Yeah. So instead, Buffett breaks things down by business segment because that's how he actually thinks about the company.
I mean, it makes sense.
Yeah.
That's how you really understand what's going on.
Right. And it's so valuable for us
Right.
trying to understand his investment approach.
And it's about looking at the parts to understand the whole right.
Exactly.
That's how we can apply this to our own investing.
And, you know, it's interesting.
Yeah.
He doesn't just use the restated, like, post-merger numbers. He includes the historical figures, too.
Oh, so he's giving you both.
It's like he's saying,
Yeah.
look, here's the technical picture, but don't forget about the context.
It shows real commitment to transparency.
Yeah, wouldn't you say?
Absolutely.
He's giving shareholders all the pieces of the puzzle,
Yeah, he's not hiding anything.
even if it's a little messy.
Right. Even if it's complicated,
He wants them to really get the full story.
that's important.
Okay, so let's talk about the results.
Okay.
19.4% return on equity
Wow.
from operating earnings.
That's amazing.
You'd think everyone would be celebrating.
Yeah, popping champagne.
Right.
Definitely impressive, no doubt.
But, you know,
Yeah.
a huge chunk of Berkshire's earnings comes from insurance.
Right, of course.
And 1978 was a peak year for that industry.
So they were riding that wave.
Yeah, and what makes this letter so interesting is that Buffett is already warning
Oh, no.
that this amazing performance
Yeah.
isn't going to last.
So he's saying, don't get used to this.
He even predicts the insurance cycle will turn downward in 1979.
So he's like looking ahead.
How could he know that?
Yeah, was he just guessing?
Was it just a lucky guess?
I mean, Buffett isn't really known for lucky guesses.
Right.
He's known for being thorough, you know?
Yeah.
His secret weapons are really
Yeah.
his understanding of insurance and his focus on long-term trends.
He's not just thinking about the present. He's already thinking about the future.
Right, exactly.
So let's dig a little deeper into insurance.
Okay.
The letter actually breaks down each segment, and one manager really stands out.
Oh, yeah.
Phil Leach at National Indemnity.
Okay.
His performance was just off the charts.
What was it like?
Almost $11 million in profit
Wow.
on just $90 million in premiums.
That's incredible.
And I love how Buffett actually praises
What?
him by name in the letter.
So it's not just about the numbers for him, it's about the people behind those numbers.
Right. It's about recognizing
Yeah.
that great businesses are driven by talented people.
Yeah, and I think it says something about Buffett's leadership style, too.
Oh, how so?
Well, he's clearly someone who recognizes
Right.
and celebrates achievements, and that probably creates a really strong culture within his companies.
Yeah, makes a lot of sense.
So, but it wasn't all perfect, was it?
You know, it wasn't all sunshine and roses.
Yeah, there were some challenges.
Even in a year like 78.
Like what?
Well, the letter mentions some issues with workers' compensation
Okay.
and reinsurance.
Right, I remember.
Workers' comp was kind of a mixed bag with good results and bad results,
Depending on the state.
depending on the state. And Buffett was pretty honest about reinsurance underperforming that year.
So even in a great year, there are always areas that need improvement.
Yeah, that's a really good point.
And he's not afraid to talk about those challenges.
He's very transparent about it.
Yeah, that's important for investors to see.
And then there's auto insurance,
Oh, right.
which was, the biggest part of Berkshire's insurance business.
Yeah, a huge part of the whole industry.
And Buffett predicts trouble ahead
Uh-oh. Why is that?
because rates weren't keeping up with rising costs.
Oh, I see. So that's going to squeeze their profits.
And this kind of ties back to his point about the insurance cycle. He was seeing those early warning signs that things were about to change.
Yeah. Even though 1978 was good, the things that would lead to a downturn were already happening.
So even when things look great on the surface,
right,
there might be trouble brewing underneath.
And this is where we see Buffett's investing philosophy shining through.
Yeah, how so?
He's not just reacting to what's happening now, he's anticipating future trends.
It's like he's playing chess while everyone else is playing checkers.
Exactly. He's thinking several moves ahead.
So this leads us to Berkshire's investment activities.
Oh.
Now, this is fascinating.
What is?
Between 75 and 78, they were buying tons of stocks.
Wow, okay.
Even as the Dow was going down.
Wait, so the market's dropping, but he's buying more stocks?
Seems counterintuitive, right?
That's not what most people would do.
Yeah, most people would be running for the hills.
Right. You'd think they'd want to wait until things were looking better.
But this is classic value investing.
Oh, I see.
He's looking for great businesses
that
are being undervalued by the market.
So he's like, I know these companies are worth more than the market thinks.
Exactly. And he's betting that eventually the market will catch up.
So he's patient.
Yeah, very patient.
And the letter points out this big contrast.
Oh, yeah.
Corporations are paying top dollar to buy whole companies.
Okay.
While Berkshire's just buying pieces of those same companies.
In the stock market.
We're way cheaper.
Makes you wonder who's making the smarter move, right?
Yeah, it really does.
It's like Buffett saying, I don't need to own the whole thing.
Yeah.
Just give me a piece of the action.
You see it in bargain.
And he uses Safeco, which is a big property and casualty insurer, as a prime example. Safeco was considered one of the best-run insurance companies.
Like, top-notch.
Better than some of Berkshire's own companies.
Wow, really?
And get this, Berkshire bought Safeco stock at below book value.
So they paid less than $1 for $1's worth of assets?
That's incredible.
That's a steal.
It really shows his ability to spot undervalued opportunities.
And his willingness to wait for the right price.
But here's the twist.
What's that?
Buffett actually admires Safeco's management so much that he doesn't want to control the company.
So he's happy to just be a shareholder.
He's content letting them keep doing what they do best.
It's like he's saying, you guys are doing great. I trust you.
It's a really important point. Sometimes the best investments are the ones you don't have to micromanage.
It's about finding those companies with great management.
And letting them do their thing.
And this brings us to something really important.
Okay.
Buffett's philosophy on retained earnings.
I'm really curious to hear more about this.
It's fascinating.
It's not something we talk about every day.
No, it's not.
So what's so special about retained earnings?
Well, I think we need to take a deeper dive into that.
Okay, great.
But maybe we should save that for next time.
Yeah, that sounds like a great cliffhanger.
We'll pick up right where we left off in part 2.
We'll uncover the secrets of retained earnings and more.
Sounds good.
Stay tuned.
We'll be right back.
Okay, so we're back and ready for more from Buffett's 1978 letter.
All right.
You know, one thing that just keeps coming up is how Buffett doesn't see stocks as just like pieces of paper. He's buying ownership in actual businesses.
He's thinking like an owner, not just a trader.
It's not just about the stock price going up.
Right, exactly.
It's about really digging into what makes that company tick.
What makes it a good business.
And what gives it a competitive edge, like over the long term.
He wants to understand the fundamentals.
Which brings us back to Safeco.
Okay.
It seems like a perfect example of this. He sees this great company, but the market isn't really giving it enough credit.
So the price is too low.
And that's where his patience comes in, right?
Yeah, he's willing to wait.
He's not in a rush.
For the market to catch up.
It's not about those quick games. It's about long-term ownership.
Long-term thinking.
And it's interesting how he contrasts this with all the corporate acquisitions that were happening back then.
Like the late 70s, right?
Yeah. Companies were paying huge premiums.
Everyone wanted to buy.
Often getting caught up in these bidding wars.
Yeah, trying to outbid each other.
But Buffett was just patiently waiting.
Sitting back, waiting for the right deal.
For the market to offer him a good deal.
He wasn't afraid to be different.
He was definitely contrarian.
Yeah, while everyone else was focused on the short term, he was looking at the long term.
He saw the bigger picture.
It's a good reminder that investing success isn't about following the crowd.
It's about sticking to your own principles.
Right.
And having the conviction to go against the grain.
When you see an opportunity.
Exactly. And this long-term view really ties back into his approach to retained earnings.
Yeah.
I know we talked about that earlier. But I'm still a little bit fuzzy on why they were so important to him.
Okay, I can explain.
Especially in this letter.
So 1978 was a time of high inflation, right?
Oh, that's right.
And interest rates were going up.
Okay.
Making it expensive for companies to borrow money.
To grow, yeah.
So reinvesting those retained earnings became even more valuable.
I see. It was like free money, almost.
It was a way to fuel their growth.
Yeah.
Without taking on more debt.
Makes sense. And for Buffett,
right,
this was a sign of a well-managed company.
One that could generate its own capital for growth.
He saw those earnings compounding over time.
Creating more value.
Like a snowball effect.
Exactly.
It's not just about sitting on cash.
No, it's about putting it to work.
It's about reinvesting it effectively.
To create even more returns.
So this applies to all the companies Berkshire owned, right?
Not just the ones they fully owned.
Okay.
But also the ones where they had minority stakes.
Like Safeco. So even if he wasn't in control.
Right.
He still wanted to see companies reinvest wisely.
He was looking for those compounders.
These businesses that could keep growing.
And reinvesting those profits.
It's all about the long game, right?
Absolutely.
But, you know, this letter isn't all just about insurance and retained earnings.
No, it's not.
We also get a glimpse into some of Berkshire's other businesses.
Like a peek behind the curtain.
There's Illinois National Bank.
Okay.
Run by Gene Ebeg.
I remember him.
The letter highlights how incredibly efficient they were.
They were really good.
Earning 3 times the industry average.
Wow, that's amazing.
While taking on less risk.
So they were profitable and safe.
It's another example of Buffett seeking out businesses with a clear advantage.
In this case, their low costs.
And their lending practices.
They were very prudent.
But here's something interesting.
Okay.
The letter mentions that Buffett actually had to sell the bank.
Oh, really? Why?
Because of regulations.
Oh, so it wasn't his choice.
Yeah, there were laws back then that limited what types of businesses a company like Berkshire could own.
Even though it was doing well.
Even though it was a great performer.
He had to let it go.
It's kind of sad to think about.
Yeah, imagine the returns.
They could have had.
If they'd kept it.
But even though they had to sell.
Right.
It still shows his talent.
Yeah.
For finding great businesses.
Even outside of insurance.
The letter also mentions Associated Retail Stores.
Okay.
Led by Ben Rosner.
What about him?
He was 75 at the time.
Wow, so experienced.
It seems like Buffett really valued that.
Experience, yeah.
And those owner-minded managers.
People who think long-term.
It's a recurring theme in this letter.
Yeah, it keeps coming up.
The importance of having the right people.
In the right places.
But beyond the specific businesses. What's really fascinating to me is how this letter reveals the evolution.
Like how his thinking was changing.
Of Buffett's investment philosophy.
It's becoming more refined.
He's not just looking for cheap stocks anymore.
Right.
He's looking for great businesses.
Companies with staying power.
He's emphasizing management.
And long-term thinking.
And he's not afraid to be patient.
To wait for the right opportunity.
Even if it means going against the market.
Yeah, even when everyone else is panicking.
This letter is like a masterclass.
It's in value investing.
Packed with insights that are still relevant today.
Absolutely. Timeless wisdom.
So much to learn from it.
Yeah, definitely a lot to digest.
Yeah. Let's take a break.
Okay.
And then come back to the final part.
Wrap it all up.
Of our deep dive.
Sounds good.
Okay, so we're back for the final part of our deep dive into Buffett's 1978 letter.
All right, let's wrap things up.
You know, it's amazing how much we can still learn.
Yeah.
From something written almost 50 years ago.
It really shows how timeless his principles are.
Like the market changes. The economy's up and down.
All the time.
But the fundamentals of finding good businesses and owning them.
Those never change.
Those are always the same.
The core,
And, you know, one thing that's really stuck with me is this whole idea of retained earnings as kind of like a hidden asset.
Yeah.
It's not always obvious when you're just looking at the balance sheet.
You don't see it right away.
But it can be such a powerful driver of growth.
It's like a secret weapon.
Yeah, it's like...
It's fuel for growth.
When a company reinvests wisely, those earnings can compound over time.
Creating even more value.
You're like that snowball effect.
Yeah, exactly.
But it's not just about holding on to the cash, right?
No, it has to be smart reinvestment.
It's got to be the right decisions.
Just because a company isn't paying dividends doesn't mean they're creating value.
So how do you know?
You got to understand their strategy. How are they allocating that capital?
Are they investing in projects with good returns?
Or are they wasting it?
It sounds like Buffett was really digging deep.
Yeah, beyond the surface.
It's not just about the earnings number.
No, it's about the quality of those earnings.
He's assessing the management.
Right.
And their ability to use that capital well.
He wants to see that return on investment.
Turning every dollar into more than a dollar.
That's the key.
It's like finding a money-making machine.
That keeps going and going.
That's the dream, right?
But this all comes back to patience.
Oh, yeah. That's another big theme in the letter.
Patience is key, especially in investing.
Buffett wasn't trying to time the market.
No.
He was buying businesses he believed in.
Holding them for the long run.
It's that saying.
Yeah, what is it?
Time in the market beats timing the market.
Exactly. You got to stay invested.
But it's not always easy to be patient.
Especially when things are crazy.
When the market's volatile.
Yeah, it's tough.
But that's where conviction comes in.
You have to believe in your investments. Yeah.
And be willing to ride out those ups and downs.
It's about having that long-term vision.
Not getting caught up in the short term.
Blocking out all that noise.
It's a good lesson for life in general.
So as we're wrapping up,
yeah,
what's the biggest takeaway
from this letter
that you think our listeners should really
take to heart?
Yeah, what should they remember?
I think it's the importance of thinking like an owner.
Okay.
Not just buying stocks.
Right.
But really understanding those businesses.
Aligning your interests with theirs.
You're a partner in that business.
Do your research.
Focus on the long term.
It's about building value.
This letter gives us a roadmap.
For how to do that.
The principles that made Buffett successful.
Finding great businesses.
Working with good managers.
Letting those investments compound.
It's a timeless approach.
That can help anybody.
Build wealth.
Achieve their financial goals.
And it's amazing how relevant this letter still is today.
Even though it's from 1978?
Principles are just as true now. It's really powerful stuff.
So I want to leave our listener with a final thought.
Okay.
Buffett talks a lot about finding undervalued companies.
Yeah.
What are some signs you can look for?
Oh, that's a great question.
To find those opportunities today?
What should people be looking for?
Think about the things we've talked about.
Okay.
Strong financials.
Yeah.
Competitive advantages.
Good
high returns on investment.
Reinvesting those profits wisely.
Find companies you understand.
That you believe in.
The journey of discovery is half the fun.
Absolutely. Well said.
So that wraps up our deep dive
into Warren Buffett's 1978 letter
to Berkshire Hathaway shareholders.
We hope you enjoyed it.
And learned a lot.
Until next time, happy investing.